Mutual of Omaha. I've been here about 11 months, and prior to that, I spent 4 years at One America and 15 years long-term care at Genworth. So a lot of experience in both asset-based and traditional long-term care. So today I want to go through just sales ideas. I'm assuming there's a question box they can monitor. It doesn't really lend itself to questions. But we'll certainly, if there's something you want me to expound on or questions, please go ahead and ask. So let's go ahead and get started. Cost of care. Nationally, around $55,000 here. That's home care, $56,000 assisted living, $104,000 for nursing home. But here's how I utilize this. We have a cost of care calculator. And you can go to our sales professional access, the SPA, if you're appointed with us, and you can have access to this. And you can pick a state, so you can hit North Carolina or whatever. And then you can pick a number of years out if you want to see what that cost is in the future. Now, here's a good stat to write down. First, when people buy, the average person who buys long-term care is around age 57 and dropping. All right. So let's go to age 55 to round it out. The average claimant is age 79. All right, so I buy this in my mid-50s and I'll use it around age 80. I'm going to show a 55-year-old what this cost is going to be 25 years from now, which is $224,000. And here's how I would use this. Mr. and Mrs. Jones, $224,000 25 years from now. That being said, the average life expectancy of somebody with Alzheimer's is 9 years. So that means half of them are longer than that. Parkinson's, 15 years. MS, 22 and a half years. So let's say, Mr. Jones, you get dementia, Alzheimer's, and it's a 9-10 year event. That, at $224,000, that's over $2 million, $2 to $2.5 million. What would that do to your portfolio? Did I wipe it out? Did I put a lot of stress on it? What's your wife going to do? She's going to go back to work at age 90? So you want to talk about what that cost is in the future. So if I have a 60-year-old, I'm going to go out 20 years. All right, now sales ideas. RMDs. So required minimum distributions. I hit age 72. I have qualified money. Government requires me to take a percentage of that out. They want their taxes. All right. A lot of people do this kicking and screaming. You don't want to do it. I don't need the income and I want to pay the taxes. Well, Mr. and Mrs. Jones, let's talk about that. Let's put that to work. Let's say it's $15,000. Let's set $4,000 aside, go to the tax man. Let's take the $11,000 and buy a Mutual of Omaha traditional long-term care policy for both of you. And now, if you're both healthy, we put that to use. And every year, we just use your RMD money to pay for that. All right, great way to look for a way to fund it. Let's go in stacking policies here. Two ways to do this. I deal with a lot of LTC specialists, where all they do is sell long-term care. And some of them are just phenomenal. And a couple strategies they'll use. They'll take a Mutual of Omaha policy and maybe make it just 3 years and regular coverage. $5,500 a month, 3 years 3% inflation. And then they'll stack on top of that an asset-based policy. And with that, if I go through my 3 years, now I have a backup plan of the asset-based to fall back on. If I don't need that asset-based one, I have a death benefit with that. I get my money back, right? So you can stack the two together. A lot of times it's less expensive. Another way of doing it, and we're getting a lot more 40-year-olds buying long-term care, is get 40-year-olds and just get a small policy, because they may not have the means yet. But it's inexpensive because they're so young. So we go down to age 30. We're kept at age 79, except for New York, age 75. So I'm going to get this 40-year-old, maybe just a $3,000 a month policy, $2,500, $3,000 a month, and then go for my normal 4 years and 3% inflation, or even knock it down to 2% inflation. All right. And then when I hit 50 or 55, I layer on another policy of 2,500 or 3,000. All right, for 4 years and 3 or 2% inflation. And then if I need more, I can do that when I'm 60 or whatever. So I layer this. It's a great way to start getting them when they're younger. All right, bear market in retirement. So I'm in retirement, I'm pulling my 4% out of my portfolio or whatever that magic number is. And then I hit a bear market. I'm going to hit statistically 4 bear markets in retirement. I hit the bear market. And then on top of that, now I have a $224,000 nursing home expense. All right. So I'm pulling money out. I'm a bear market. I think on average a 30% decline. And now I'm pulling $224,000 out a year for nursing home. Is that going to put some stress on my portfolio? You better believe it. Is that going to put some stress on me and my wife? Just mentally, you better believe it. Because we don't have a crystal ball. We don't know how long the bear market's going to be. We don't know how long I'm going to need care. If I transfer the risk, I take that off the market, off the plate. One less thing to worry about, right? So there's a way to position it to them as something to think about. And then no single premiums. Hey, asset-based products are very good products. Good companies. The only reason I bring this up, if you're not managing somebody's money, or maybe you don't have a really strong relationship, and you bring them an asset base and say, we need 250,000 or 300,000, and they say, great, we can do that. They're not going to go to the bank to get that money, right? They're probably going to go to their money manager. What do you think that money manager is going to say? He doesn't want to give up the $300,000. He's going to say, you know what, John? You don't need this. You can self-insure. Now you just killed the deal. Who's right? Who are they going to believe? All right. So you just want to be careful on relationships and what kind of relationship you have with this client if you're offering, something with a single premium. There's something to think about. Again, they're good products, good companies, just something to think about. All right, assumptive close. I spent years in the home improvement business before I got into insurance 20 plus years ago. And sitting across the kitchen table and teaching people how to do that. And then when I got with Genworth in the beginning, I had the money managers, wealth managers, and so I had to do a lot of assisted sales because they didn't understand long-term care. All right. The close I used the most was the assumptive close. I would have the application sitting next to me the whole time I was talking to them. Let them see it. And then as I would go through things, if I'm getting the nodding heads, as I'm explaining why this is important, statistics, how the policy works, everything they get for that policy, how an illustration works, and I'm getting nodding heads all the way through when I show the premium, I'm not going to ask for an objection. I'm just going to start writing. What's the proper spelling of your last name? What's your social security number? Whatever. 70% of the time, they never stop me. All right. Don't go looking for objection because they'll give you one if you ask. The 30% that did, I would just, no, never an issue. Just, oh, I'm sorry. And again, I'm not going to do this. I'm getting pushback all the way through. But then if they did, I'm sorry. I thought you were comfortable with this. What are your concerns? And then address it. But one of them might just be a knee-jerk reaction. I want to think about it. Okay, that's great. Let me ask you a question. Would 30 to 40 days be enough time for you to digest this? And they go, yeah, John, no, more than enough. Great. Well, here's the thing. I don't even know if you guys can get this coverage. Now I'm going to do a takeaway, right? It's up to the carrier to see if you're a good risk for them to take and put on their books, right? So they may look at this and say no. So here's the deal. Why don't we do this? Let's fill out the application. It's going to take the carrier 30 to 40 days to decide whether they want you as a risk. If they do, they're going to send me a policy. I'm going to take that policy. I'm going to come to you. And we're going to sit down and I'm going to go, John and Mary, is this something you want now that you thought about for the next 30, 40 days? Yes, they'll take you on as a risk. They're going to end up doing it, right? So that's a way to, again, get them off. I want to think about it. And you're taking it away a bit. All right, top advisors will create the illustration with the client. So I've got guys that are just sell a ton of this, and they'll do this. They'll pull up, whether it's on a Teams, call or a Zoom or whatever, or if they're face-to-face, they'll pull up the software and let them design it with them after they set the stage on the importance and why. And I think it's pure genius, because here's what happens. Every time you change a button on it, you see the premium move on ours, right? So you start off, Mr. and Mrs. Jones, most people in this area, I recommend anywhere from 5,000, 6,000, or 7,000 monthly benefit, all right? Now, with your means, let's just take maybe a look at 5,000, or let's look at 6. And then I usually recommend 3 years, 4 years, or 5. When we start with 4, and they go, yeah, let's look at 4, and then they see the premium. Oh, that's manageable. What would 5 years cost? All right, and then you add the inflation or whatever. And now you start playing with it. Let's add shared care. Here's what 0-day home care does to this. And now they help you design it. They own it. They built it. It's pure genius. All right. Now, bottom one, affiliate loss. This is dormant in states, but Medicare and Medicaid are broken more so than Social Security. They weren't designed to pay for long-term care, and they pay the majority of it. So what this filial law means is, if I go on Medicaid in these states, the state actually has the right to come after my adult children and say, you need to reimburse us for your dad's care. They have that right. Okay. Now, there's only a couple times it's happened. There was one in Pennsylvania, and I'm sure there was extenuating circumstances. The adult son sued and lost. But the thing is, this stuff is broken, and they could enact this at any point, make it live. So in those states, I see North Carolina's on here, you may want to just mention that as one more arrow in your quiver on why you may want to look at this. You can Google it if you want more information. Let's talk about wealthier clients. They will buy this. Now, some just knee-jerk reaction, I'm going to self-insure, right? Whether they should or not, I think anybody should buy it. Just for the same concept right here. Concept of using other people's money, pennies on the dollar, taking a small piece of your portfolio to protect all or a majority of it, and leveraging. Insurance has served them well over the years. They know that, all right? So a few stories on this. I can't remember if it was you guys, Gene Pleasant Agency, or somebody else was telling me they had sold somebody recently with a $50 million net worth.
That was us, yeah.
Right?
Yeah, at one of our meetings, yeah.
Yeah, that's what I thought. So, and the agent asked why you bought it, and he said, because I'm concerned when I get ill, my adult children are going to be more worried about the money than they are me. Right? Even though he had it, he's like, I want to make sure I get good care. That was his honest answer. Right? And I've learned over the years, the more wealthy, sometimes the more dysfunctional a family too. Right? I had one in Tennessee probably 15, 20 years ago when I was with Genworth, $40 million net worth. They just went on claim, one of them. Just claimed with Genworth recently. I bet they're glad they have it. And there's another story. I had a couple had a $7 million net worth, and never forgot this one. They asked her the same thing, why'd you buy it? Well, 2 reasons. One, my husband does not do a good job of taking care of me when I get sick. Second one is, why would I give my money to the healthcare industry? Why just give it away? I worked 40 years to build this up. You just give it away to the healthcare. And I never forgot that one. I thought that's very profound, especially with wealthier clients. Yeah, you have the money to do it, but why would you do it? Why give it away? And I'm going to tie another story into that. Advisor years ago, and I think he was in South Carolina or North Carolina, and he goes, John, I offer this to everybody except for my wealthier client. So, whoa, wait a minute. Why not wealthier client? They can self-insure. So really? Because yeah, I'm going to meet a doctor next week. He has a $5 million net worth. All right, let me ask you a question. Let's say his house is worth $1 million and it's paid off. When you meet with him, would you tell him to cancel his homeowner's insurance? It's like, no, why would I do that? Well, he's got $5 million. The house burns down. He's got the money to replace it. Why give that money? Why pay that money to the carrier? Even though there's like a 1% chance that's going to happen. Well, no, that doesn't make any sense. Then he got it. Light bulb went off. Okay, I get it. If we're not going to self-insure this, why would I self-insure that risk? Because here there's a much better chance I'm going to have a long-term care event than my house burning down, right? So same concept, all right? Now, there's another thing in here called Lossless Step Up. And I have some advisors, I had one who said every client was over $1 million, he tells every one of them to do it for this particular reason. Now, there's a caveat to this. Biden is going to go after this step up. So be careful because it may go away. Here's how it works. We're not familiar. I buy a stock today. I'm 60 years old and it's $10. Age 80, I go on claim. That stock is worth $100 right now. I go on claim. And I need care. I go through my liquid money first. And that's $400,000. Now I got to liquidate something. I liquidate that stock. If it's at $224,000 a year for a nursing home, I got to take out $300,000, right? I got to pay taxes. But the bigger deal is I lose step up in giving that to my adult children when I pass away at 100. They don't have to pay taxes on that. They get it $100. But if I liquidate it, I lost that opportunity. If I have a mutual of Omaha policy, I protect that and we pay the care. So losses step up. Let's go to a waiver. If I were you and I'm dealing with somebody, especially with clients that are clients, and it's just not a, or somebody will be a client, it's just not a lead. I'm not getting lead generated sources. I'm going to have them either sign a waiver or sign that illustration when I'm done if they're not going to buy it. And write, reviewed, not interested initially, and date it. For a couple of reasons. One, to emphasize to them how important this is in retirement planning. Two, to protect yourself, because if they go through their assets and didn't have them protected and you met with them, who's going to come after you? Adult children, right? And that happened in Colorado. And yet that advisor had shown long-term care, but he didn't have any proof. So he lost $600,000 judgment. And guess what? His E&O didn't cover him because it was the adult children that sued him, not the client. So the other thing is, one, to emphasize the importance, and two, to protect yourself. And the last one on here, care coordinator services, build this up with the wealthier clients as a concierge service. Mr. and Mrs. Jones, when you go on claim, you have a concierge service at your disposal. With Mutual of Omaha, there's going to be a care coordinator. The same coordinator will talk with your family members all the way through the case. As long as you're on claim, it'll be the same care coordinator. They'll build a relationship with the family. They're going to help give you 3 reputable in-home, assisted living or nursing homes, help lay out a plan of care and adjust that over time. All right, you want to lay that out. I'm just going to do a check. Do we have any questions yet? No? Okay. This I took from like a principal of a long-term care agency, and I love this. It just draws it out on a piece of paper. Retirement age. You've got 100,000 of income coming in. You go on care, you need care at home. It's around $51,000 a year. So now your income just dropped to $49,000 to pay your bills and stuff. Retirement B, they bought a Mutual of Omaha $7,000 monthly month policy. So now their income is $184,000. In retirement, you had an event. Would you rather be carrier A or carrier B? So you may want to take a picture of that, a screenshot. I think that's a great way to position it. Very simple. All right, if there's an event, what happens? It's a stress level goes up. There's most people have a plan in place. Emotional, bless you, emotional incompetence.
Thank you, sorry.
Irrational decision making, and daughter quits her job or son. All right, and then that healthy daughter no longer can handle it. That becomes she becomes unhealthy. We put mom or dad in a nursing home. Right? Statistically, there's a 40% chance I can go to a nursing home. 40% chance. But if I have a policy, and I would encourage you to write this down, only 13% of the claimants are in a nursing home. That's a Genworth and a One America stat. Only 13% are in a nursing home, 13% assisted living, 74% at home. So some advisors call this anti-nursing home insurance. All right. Now, I'm going to give you a 3-step sales process, and there's nothing else you pay attention to or take notes on. This should be it. If you follow this, the sale becomes self-evident. My biggest pet peeve is most advisors don't lay out a plan at all. They don't have a dialogue. They just go through the illustration. They go to Marshall and the team and they go, give me an illustration. They walk through it. The client tells them it's too expensive and you blame the carrier. I never heard it was too expensive. If you lay it out appropriately, they get the value. They actually think it's a deal. So 3-step sales process. Please write this down. First one, Mr. and Mrs. Jones. People are living a longer life. Second, this is a family issue. Write that down. This is a family issue. Third, if you have an event, how are you going to pay for it? I'm going to give you a flavor around these. So first one, people are living a longer life. Think about the things, Mr. and Mrs. Jones, that were fatal to your parents and grandparents. They're now manageable. All right. Cancer, we catch it pre-stage 1 a lot of times. Or if not, we have better treatment. Heart issues, throw a stent, 3 stents in you and send you back to work. You know, so now I live to 90, 95. What's your game plan? I just need help because of aging. Or keep in mind, because I lived through all that, and now I'm 85, 90 years old, what 2 things do I have to worry about? Getting dementia and Parkinson's, both long tails on them. Now, second, this is a family issue. There's a good stat at the bottom here. If I hit age 65, there's a 70% chance I'm going to have an extended care event. Every carrier uses that. If I cut that in half, that's still significant. And let's put it in life insurance terms. If I came to you as a 40-year-old, right? I know I look a lot younger than that, but let's try to vision I'm a 40-year-old. I'm a 40-year-old. And I have no planning. I'm pretty sure you're going to tell me I need insurance. I'm the breadwinner of 3 kids. So I asked our actuaries, what are the odds I die at age 40? 1 to 2%, that's it. But yet that's a staple, got to have it. Well, I'm not doing it because of the odds. I'm doing it because of the consequences. Well, here's something I'm telling you is a 70% chance. Yeah, it's not a staple. And the bigger deal right here is if this is a couple, that extrapolates out to a 91% chance one of you is going to have an extended care event. And please write that down and communicate that to your client. 91% chance one of you is going to use this. Now, let me talk about the family issue. Families are smaller nowadays, 2 to 3 adult children. Sometimes you have demographic problems. All 3 move out of the area. But let's say all 3 live here. Here's the key question to write down. Mr. and Mrs. Jones, if one of you needed care, do you think all 3 of your adult children are going to raise their hand and help the same amount? They're going to go, no, it's not going to happen that way. They're going to get it. They're going to go, John, Mary's she's an attorney. She lives 60, 70 hours a week. No, she can't help. John, the middle one's a guy. He lives a little bit further away. He's not going to do anything. Susie's going to do all the work. Okay, so Susie's going to do the work. You think there's going to be animosity between Susie and John? You better believe it. This tears families apart. I'm going through it with my mother-in-law, who's like 88, semi-self-sufficient. My wife has dinner with her once a week. As an immediate family, we try to do it every other Sunday with her. One sister tries to help, has some health issues. Another sister lives like 25 minutes away. She's only been able to visit once, maybe called once in the last 5 years. The brother lives 45 minutes away, so he has not been able to visit the 88-year-old mother for 2.5 years, and calls on some of the big holidays, though. He's great. All right, we don't get together on that side of the family. My wife does almost everything. This tears families apart. You need to have a plan in place. Your clients will get it. Third piece of this, if you have an event, how are you going to pay for it? If you don't have a plan in place, you're self-funding. You've exposed the whole portfolio. It's a $300,000 event. It's $300,000 of your money gone. If it's $1 million, it's gone. If it's $2 million, can't even ring the bell. It's too late. And that happens in today's dollars. A numerous 2 million. The highest I've heard is 5 million somebody went through today's dollar. My mother had MS for 40 years, was in a wheelchair for 20 of it. All right. My father passes away. We run out of money. She ends up eventually on Medicaid in a nursing home. About 2.5 years ago, passed away. I did back of the envelope math. If she had a Mutual of Omaha policy, easily would have been a $2.4, $2.5 million claim. Today's dollars, easily. Transfer the risk. All right. The other thing is you got to let your clients know that Medicare and Medicaid are not the panacea. Medicare, 100 days stops. That's it. Medicaid, for the indigent. Bring your assets under 2,000 like my mother did, and then you can get nursing home care, typically, is what she had. I had it killed for even a 2 or 3 year policy. Third option, Mr. Jones, let's transfer the risk. If you use this, the sale becomes self-evident. I cannot emphasize this enough. It's so easy. Use, please, those 3 steps. Have the dialogue. All right. Some clients are going to say, hey, we're going to self-insure, John. We're going to set $250,000 aside. We're good. Really? I can show you a better way to do that. So I have a couple age 55. I use $5,000 a month benefit here. 3% inflation, 4 years benefit each, full return of premium. $8,700. Guess what, Mr. and Mrs. Jones? When you hit age 80, I told you that average claim was you're going to have $1 million worth of coverage. $1 million. Holy cow, John, that's awesome. But wait a minute. What if I don't use it? Well, I added return of premium. So with us, age 64 and below, eligible for full return of premium, less claims. And that's only on custom solution. I spent $219,000 over the last 25 years. You're going to get it all back. Every penny. So for the last 25 years, you've had this peace of mind and comfort that you knew you're going to have $1 million out there if you needed it. And if you didn't, you're going to get it all back. All right. So that's a big deal. All right. Now, here's something, a great sales idea on how to handle the objection. I got kids in college. This inflation buy up and buy down is on our custom. It's another thing that's only on custom, which is why I like our custom product better than secure. You want to hit people at age 55, right? But you're going to hear, you know what, John, I got kids in college. I can't afford this yet. Well, wait a minute. Here's what we're going to do. We're going to do this. We're going to put 1% inflation only on, make it affordable. In 3 years, the first kid's out of college, we can up it. I can adjust this on the fly. Policy anniversary to 2 or 2.5. You said the second kid's out when you're 61. We can adjust it again on policy anniversary to 3 or 3.5. When you get to age 80, and now you say, hey, I got robust coverage, I can knock it down. So I can go up for the first 20 years until I hit age 75. I can always go down. I've always been asked over the years, what if my financial situation changes? Do I have opportunity? I do here. I have flexibility. This is huge. All right, just a few riders that we have that have sales ideas built into them. Shared care. If you're not familiar with long-term care, you're talking to a couple, Mr. Jones, a lot of times, we think we're invincible. Nobody can touch us, or we're not going to get anything. No issues. Well, we're vulnerable. We get dementia, Parkinson's, MS, all of it. But so Mr. Jones, here's what we're going to do. You get a 4-year policy, your wife gets a 4-year policy. We're going to connect them with a rider called the shared rider. If you just need a year's coverage, you have it. But if you don't need any of it, it's here. Your wife goes to hers, she can come over and use yours now. And guess what? Your premium is less than hers, so she's getting yours at a discount. All right? So that's a great way. I love shared plans. And they have to be identical coverage. So both have 3 years or 4 years. It's awesome. Security benefit. Pay attention to this one. A lot of people are not aware of this. I love it. My wife and I apply, she gets declined. Or like my mother has MS and can't apply. I'm going to add the security benefit to my policy. It's going to cost 60% more. That's okay. Still less than me and my wife. But when I go on claim, my benefits grown to $10,000. I'm using all of it. I get another 60% of that, $6,000 cash to do whatever I want with. It does not deplete my pool of money. I can buy a new car if I want. But theoretically, it's there to take care of my wife. If she doesn't need care, bank it. After a year, it's $72,000. After 3 years, it's $210,000. I love that. All right, we talked about return of premium, bottom one. On our policy, it's reimbursement, but you can pay somebody cash with us. This is a huge deal. I can make it look like reimbursement. I can pay somebody cash as long as they have a certification. I didn't say nursing degree, just a certification. So I can go to night school for a week or something and get certified that I know how to lift people without them getting hurt, manage medications. And I can pay, as long as it's not a family member, I can pay them cash, neighbor, friend, whomever. All right, huge deal on ours. All right, we talked about care coordinator, partnership. A lot of people, there's value here. I grew up in a blue collar family in the South Side of Chicago. My dad worked hard to take care of us. When he realizes that at the end, he realized when he passes away, we would have to use the home equity to take care of my mother. He was devastated that he couldn't leave that as a legacy for us. His father was blue collar and left a legacy for he and his siblings. All right. Had we been able to get a policy, which couldn't, he could have done that for my mother. All right. So the key is partnership means I buy a pool of money, let's say $300,000 pool of money, I go through it. And only traditional long-term care can do this, asset-based cannot. So now I have $500,000 worth of my own assets. I go through 200,000 of them, I can stop, protect 300,000, and go on Medicaid if I want. The government will let me. All right, they want to encourage us to buy long-term care. All right, now you just have to have the right inflation protection on here to qualify. So let me see something. North Carolina right here. Depends on the ages, whether you need 3 to 5% or 1 or 5%. But anyways, Marshall and the team will help you with that. This is a busy slide. Doesn't cost anything extra for partnership. Business owners, please pay attention here. So underutilized. You've got business owners. They love running things through their business. If it's a C Corp, it's 100% write-off, 100%. Take advantage of it. Pass-throughs, it's tiered by their age. So, and actually, 100% write-off for the spouse. So if I have an LLC that's not a C Corp, if I have a sole proprietor, whatever it is, partnership, it's tiered by my age. So if I'm 51 to 60 here, I can write off $1,690 of my premium. $1,690. My wife is the same age, $1,690 for her. That's $3,380 on my K1. I just put health insurance expense, $3,380. Take advantage. And if you've got business owners, doctors, lawyers, they have partners. So instead of just selling your client, get all 3 or 4 of them. You can use SSA, HSA money, MSA money. Here's some key phrases. You may want to screenshot this or take a picture of it. Some of the ones I really like are in bold: 70, 70, 70. 70 million people turning age 70, 70% will need long-term care. If one of you has a healthcare event, which assets would you liquidate first? This is what I would use if they're giving me pushback. Okay. So Mr. and Mrs. Jones, you have an event. Which assets are you going to liquidate first? I mean, what do you mean liquidate? Well, yeah, if you have an event, you got to pay for it. It's a nursing home, $224,000 a year, Troy. How are you going to do that? And that's going to freak out Mrs. Jones because she's worried if it's me and we start liquidating, what's she going to live off of? Plan is designed not to make you rich, keep you from being poor. Repurposing, mission focus. So just some terms that you may want to utilize. Or getting close to the end here. We have numerous brochures. I'm not a brochure guy, but we have some really good things that you can utilize. We have an e-app, cuts down cycle time. It's great. People don't want to meet with you also with COVID. We have some brochures that you can send digitally or that you can actually have your contact information put on them. Co-brand. The 6-step sales brochure is really good because it tells you the 6 steps of the sales process, different brochures or things we have to support it. We have a consumer video. This is great, 2.5 minutes. And a lot of advisors will send this to their client before they sit down with them. Say, hey, I want you to watch this before we meet, or start the meeting with this. All right, we're just about done. Here's a slide on us versus asset-based. And I'm going to, asset-based products are very good. They're very good companies, all right? I call it the Ferrari. So when I was at One America, we raised our premiums 3 years ago extensively. Sales went down tremendously. All right, they're good products. They're good companies, but it's a Ferrari right now. And if somebody can afford it, great, God bless them. But not everybody can, so you need alternatives. And instead of the movie Ford versus the Ferrari, I'd like to think we're a Cadillac. So I told you $8,700 for that coverage earlier in the day, in the slides. Carrier A, one of the top asset-based, same exact coverage, is almost $13,000. Over that 25 years, they'd charge an extra $100,000 for that coverage. Carrier B is $11,000 versus my 87, but their death benefit doesn't even cover. It's $100,000 short, giving your money back. And it's better coverage with that carrier. But there's another thing to keep in mind here, though. They typically don't put inflation on the base policy. So you hit age 80, you still are at $5,000 a month monthly benefit at age 80. If it's a couple, that's for 33 months. So if I have an extra $7,000 because I don't have any growth that I have to pay out of my pocket for 33 months, that's $231,000 extra out of my own pocket on top of the $276 I paid in. So we compete well here. And if I don't have ROP enter, I'm only $5,100. All right, and versus life with the riders, 63.71 here and 57 here. With ROP for this type of coverage over here, different coverage, I'm at $1,800 and $2,500. We can compete well. All right, we're just about done. Some ideas here for partnering, some centers of influence, CPAs. I was just on a call with somebody else recently. They said they asked their CPA who they use, and they said, we don't have anybody. So they hooked them up with one of their advisors to target the business owner, estate planning attorney, divorce attorney. Let's say I'm wealthy, and now my wife's divorce attorney says, hey, John, we want you to pay for her long-term care insurance. That's part of the divorce decree. Money managers, RIAs, a lot of times they get the need, they still want to deal with it. They want to manage money. Here's our contact information. You just stick with Melinda and Marshall, your team. You've got, if you're new by some chance to Gene Pleasant's agency, you've got seasoned veterans there. All right, please reach out to Marshall and the team. They understand, they have all the carriers, they understand how to do this. So good news is the last slide, and then we'll see if there's any questions. You've just invested 45 minutes. Look at your book of business. The sweet spot is 50 to 65. Look for business owners first then, right? In that sweet spot. Look at your wealthier clients like we talked about. Don't get it. And we pay commissions too. You get paid for your time on this. And then think about single females in their 60s and 70s. They don't realize they can get this. I guarantee it's probably a concern. And then the last piece of this, so wrap it up. Think about who you're going to meet with over the next 2 weeks. Next 2 weeks. And then, are they appropriate for this type of planning? And then get with Marshall and let him customize something for you and bring that back to your clients and be proactive, not reactive. And with that, do we have any questions?
Yes, Michael has a question.
Sure.
If one spouse uses 100,000 of benefits and dies, does the partnership protection extend to the spouse?
So you're talking about with partnership?
Michael, I don't know if you
Yes.
can unmute and talk.
Yeah, basically,
There we go.
if you've got two people on a policy, okay, so the husband, say, uses $100,000 and he dies.
Yeah.
So now then, 5 years later, the spouse needs care and she goes through all the available benefits, shared care, whatever it is. Is there still going to be $100,000 protected from Medicaid? Like, it doesn't really matter quite as much, but in those, like the states you said, where they can go after someone.
Yeah, the answer is correct. They can protect the assets from both. So if he's
or if let's say the spouse, the surviving spouse uses their resources and they still have to apply for Medicaid.
Yes.
And the other spouse is, he used his benefit. I mean, is his included in the protection when the surviving spouse applies, when they apply for Medicaid?
Yes. And I can double check for you, but yes, because you had it, you went through it.
Even though it's a spouse.
Right, I got you. But it was the other spouse, but you went through it. Let me double check on that for you.
Okay.
Made a note of that. Any other questions while I'm writing this down?
I don't see anybody, but folks are welcome to unmute and ask. Open forum.
Yeah, the one thing I'm thinking about on that, I don't know if you have to deplete you might have to deplete your entire pool. Depends on the state. You have to deplete your entire pool typically to be eligible to protect. Okay. Now,
Even if you had
there's
$300,000 of long-term care benefits that were used.
Yeah. Yeah, I'll find out. Okay. If there's no other questions, thank you very much, everybody, for your time, and good luck.
No, great info. And I'll be sure to share it with the participants.
Okay.
All
Thanks,
right.
Thank you
Melinda.
very much.
Yeah, thank you.
Great info.
All right.
All right, take care, John.
All right, take care, everybody.
All right, bye.